Okay, today on the podcast, joined by Vince Scully from Life Sherpa. Welcome back, Vince.
Thanks, Glen. It's great to be back.
Hey, the $3 million super tax that was talked about, there's been a change. Jim Chalmers has come out and said, no, we're not doing this. They pretty much could have got it through. They'd been talking about it for 2 years, then it went silent. Phil Curry in the AFR started writing on little chatter that maybe the PM's office got in on it and wanted to change a couple of things. So,
well, of course, the advantage of the PM getting involved, he does actually have a degree in economics, unlike our treasurer.
Right. I didn't know Alvo did have a degree in economics.
Which on his website.
Well, there you go.
From Sydney University, of all places.
What's Jim Chalmers' doctorate in?
Paul Keating. He did the history of Paul Keating.
Right.
Which, of course, is a really good thing if you're looking for advancement in the Labor Party.
Yeah. Hey, so the plan has been shelved. It's been changed. And basically now that there will be a change to the tax over $3 million. So what has been proposed?
Well, there's probably three key changes. So first of all, the $3 million is indexed and supplemented by a $10 million threshold where the tax lifts by a further 10%. The second change is that it's based on share of realised income rather than total change in balance. And the third thing is the fact that it's a personal tax now rather than a super tax. So just like a 293 or a excess concessional tax, you can pay it yourself or take it out of your fund.
Right. Okay. So we're going to talk about it in a little bit more detail and unpack it. My name is Glen James and you are listening to Retire Right. Politics aside, obviously that has been what has killed this original plan because Jim Chalmers basically went to town initially like, this is happening. They baked it into the next 10 years of his budget. It was like $40 billion or something over 10 years or some huge amount.
Most of that in the back end. So there's like $1 billion or $2 billion in the forward estimates. Yeah.
And so as it stands at the moment, there has been no major detail announced, but they're splitting it up. So if you have over $10 million in super, that will now attract an extra 25% tax.
Yes, a total of 40.
A total of 40, yeah. And from 3 million to the 10 million will be the 15% additional.
Extra 50, so a total of 30.
Yeah.
And then the normal tax will be 15.
Right.
Or 0 if you're in pension phase.
Yes. Now, just talk to us about, so they've said that they will index it now.
Yep.
In line with the balance transfer cap.
Yes. So
maybe just explain to people how that looks in terms of the actual indexing, given that we do not have a lot of detail because of...
Yes, we have a press release.
We've got a press release.
A media release.
A media release. We don't have legislation.
Correct. And we're not going to see the legislation this side of Christmas.
Yeah. And it's proposed to go ahead on the 1st of July next
2026, yes. So for the financial year of the 27 financial year.
So I think the key takeaway is obviously the indexation and the not taxing unrealised gains.
Yeah, and this is sort of a masterstroke of political expediency because the key argument for the alleged inclusion of, or the incidental inclusion of unrealised capital gains was that rather than force the other 99.5% of the population who this didn't affect to account for all of this and build a system to deal with that 30% tax rate, it worked off the net change to the total superannuation balance. Convenient, everyone's reporting into the tax office already, no cost on the 99.5%, whereas separating out the portion of that is unrealised capital gains. Because most people, know it or not, the unit price in your super fund includes a provision for unrealised capital gains tax. So your balance already has the future tax on unrealised capital gains included in it.
So and the whole reason, like in one hand, I got it, sure, because that's how the world works already with unitized funds. But on the other hand, it's like, you want to tax me on a paper value. What could go wrong?
Well, it works fine for the Dutch.
Yeah.
But let's not, it's not exactly a major world economy.
Yeah.
So the super funds will report balances over 3 and 10 and will be able to attribute a portion of the return based on some reasonable basis rather than have to running a separate pool of assets.
Right.
So that takes away a lot of the cost implications that the old system was trying to solve.
Yeah.
So you get the cost benefits, but you also solve a couple of the other problems at the same time. So I think that's positive.
Do you think we landed on a win?
Well, it depends on who we is,
Yeah.
but I think
We the people?
I think the Australian taxpayer as a whole is better off, and it's certainly more palatable to the people who are going to vote on this in the Senate. So that's a positive. But the other big change, which also solves some of the arguments about, well, what about the family farm that's in my self-managed super fund? Both of them, is that you can now, like the Division 293 tax, you can pay it out of your own pocket. So
I thought you could have done that before this new change.
I don't think that was part of the rules.
Well,
it?
yeah, you could pay it either way. And,
well, so why was the farm
but also,
issue a problem?
why is our farm in a self-managed super fund anyway?
That's just ridiculous. No, you cannot have a material farm because it's going to have to come out as a death benefit.
Yeah.
So it doesn't solve.
Yeah, like if someone dies, that
farm's got to come out as a tax benefit.
wound. And it was funny because I saw a thing on ABC 7:30, right? And they interviewed these farmers when they would propose this tax, and they were like, "Oh, this farm have got assets." But you watch that article, the farm. They literally said our superannuation fund has investments. They were just farmers with a self-managed super fund with investments. So I think
if you're trying to solve
the train got away on that bit, I think.
And that bandwagon was jumped on by lots of rent seekers.
Yeah.
But the ability to do that and the quid pro quo, which we'll probably come back to, is there's a lift in the low-income super tax offset, which I guess is probably key to getting the Green vote to get it through the Senate.
Yeah, and I think that was the whole, because they did not need the they didn't need the independents in the Senate.
Well, they needed them or the Greens.
The Greens, yeah. Well, I think the Greens were probably more keen on taxing big money than anyone else.
Yes.
But
I think it's a pragmatic solution to a nasty problem.
Yeah.
The notion of indexing tax thresholds is not common in Australia. We index a lot of retirement and super thresholds, but the key indicators of tax, the normal personal tax rates, the corporate tax rate, these are not indexed.
Yeah.
And so it is more unusual to index it than not. But I guess the confusion is, well, we index the contribution caps, we index the total superannuation balance cap, we don't index the 293 cap, the 250,000. So it's a bit of a mishmash, and it was just a convenient
argument. Do you
think
if this does get put to bed, and we're recording on Tuesday the 14th, this episode's going up in 2 days, it was announced over the last 2 days, there is still room potentially for let's have a look on that, because I don't love talking about politics, but for this measure, it's very political, because I think if the Greens won't wave it through, the independents will wave this through, because Allegra Spender, she said, paraphrasing, that...
Oh, your best buddy from the East?
That's right. She, in principle, didn't have a problem with it. She had a problem with the unrealised gains and the non-indexation, and that's what most people had the problem with. So I think it can get waved through, but there could still be some things, and that's why I think there is so much outrage online, at the bar, at the cafes, and it's probably political science where we put something out there, throw it out, let it simmer, see what happens, and then retreat a bit. But all that to say, do you think if it got put to bed in its current form, it would make the system more complex, less complex, or just adds complexity?
Oh, well, I think it adds complexity, and there's still some serious detail to be sorted out. So the question is, well, what happens to a gain that is there today, an unrealised gain on the 30th of June 2026.
Yep.
Is it going to be taxed when it's realised, or are we only taxed gains from 1 July? It would clearly be simpler to
How
tax
will
all
it
gains.
impact the run-of-the-mill unitised fund in its current form
Well, the
that
challenge
has those unrealised
Yeah.
gains taxed, baked into the unit
Yeah,
price?
well, the super funds obviously know what the fund pre-tax income is, and they know what the total tax for the fund is, and they know what this CGT adjustment is. So reporting a reasonable allocation is a far simpler exercise than trying to go, well, what is Glen's individual capital gain? That's a really tough ask. Whereas, today they use a reasonable basis to allocate franking credits and gains across investment options and across members. So I think this is probably a win for the pooled funds.
Yeah.
Which is the lion's share of Australian accounts.
And probably a lot of the lobbying pressure, good, bad, or otherwise.
Yes.
But I mean, like,
given who the directors of most of these boards are.
yeah, it's funny because it would have been in its form, like without the change, it would have been actually quite easy for the existing funds to roll it out.
No, well, yes, it was designed to be able to simply report the net change in your total superannuation balance adjusted for contributions and withdrawals.
Yeah.
Very simple calculation. Everyone knows what it is. It's reported to the tax office already. No systems work required really.
Yeah.
And of course, our big funds track record on big systems development is not good.
No. So I think the silver lining is for those who are like, well, what if a young person now doesn't get it indexed? As long as it's indexed, the pedestrian garden variety Australian worker probably will not hit that cap anyway.
Well, certainly not in my lifetime.
No. Like I just it's a non-event, and we've always got to go back to I've been saying lately, Vince, fundamentals. It's not good when you talk about politics or religion. Keep away from fundamentals.
And money.
And
well, what are we doing today?
No, but I think fundamentally you can be a fundamentalist with money. Less tax in super, more tax outside, live on less than you earn. These are pretty fundamental things.
They are.
Would I rather pay 30% tax or 49%? It's pretty fundamental, right?
It is.
So we need to all have a cold shower. I think it is reasonable that funds that might have, $100 million in them, like, come on.
I mean, I don't think they really need a tax break.
No.
Your average plumber does not need to be subsidising people with $500 million in their super fund.
Yeah. So we'll keep on this as it develops over the weeks, but we'll be right back after this break. Hey, it's Glen here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.